All right, good evening once again. I welcome you to today's class. Um, and before I start anything, let me quickly apologize for last week. Uh, Last week there was no, uh, you know, there was no power, and I could not get fuel. There is fuel scarcity in Nigeria presently, so I could not get fuel to power the generator in order to run the class. So that was basically what led to that. And even today, um, I just have to make the class possible by all means. However, that being said, let's let's get into today's work. So last upper week, we we had a class on operational and strategic analysis, that is business analysis. Meanwhile, I told you that, you see, the two requirements in case study class or in case study exam, the two requirements in case study exam. So the two requirements in case study exam can can only be solved with just three analytical scales. And these are the three analytical scales. And we have talked about the operational and strategic analytical scale. And that is a scale we use in doing business analysis, where most of the time we will need a particular analytical tool, such as strategic business model. For example, PESTEL. Oh, sorry. Um, Let me share my screen. It was the network that locked me off. All right, so let me quickly share my screen. So, like I was saying, that these are the three analytical skills that can be used to solve any the two requirements in case study exam. And I said that 2 weeks ago we had a class you know, on operational and strategic analytical scale. So this is a scale we mostly use when there are issues around business operations and when there are strategic decisions to be made, for a business. Then we need the help of strategic business models such as PESTEL, SWOT, Porter's five forces, benchmarking, value chain model, and all sorts of models to solve the case. And we equally discuss about those, you know, sub skills under the operational and strategic skill. I equally shown to you, I showed the class five different diets where operational and strategic analytical skill have been tested, and what the assessors were looking for under these five diets, right? Under these five diets. And I told you that, see, if you can marry the idea of what and what they requested from candidates in those diets, like the use of data and information, professional tools and knowledge, analytical skill, and all those eight sub skills, right? So if you can marry them and understand that, okay, under operational and strategic analytical skill, these are the things that they need under use of data and information. These are the sort of things that they need under professional tools and other. These are the sort of things that they require from students under analytical skill. If you can get it, get the idea, that should form the basis upon which you will write anytime you see a question on operational and strategic analysis. That is the secret. And the truth is, you having me here today is basically for the fact that I know about this secret and I've shown it to you, right? However, I don't want I don't pray to have such student whereby the student that cannot study. No, 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 no. Please, I will beg you to to do further study on this analytical skill and the sub skills under this analytical skill. So building on this knowledge, then we move to financial statement analysis or financial statement analytical scale, because this is a scale, right? A scale you need to analyze financial statement, right? So we are looking at financial statement analytical. Okay, let me change it to analytical scale, financial statement analytical scale. So, um, what is financial analysis? We can start from there. What is financial analysis? That is simple. It's basically analysis on financial data, right? And financial data could range from you know uh, the data you can find on the financial statement on one hand. What are those statements on financial statements? We have the income statement. You can also call that a more fancy name, which is a statement of profit or loss. We also have the balance sheet, which you will call the statement of financial position. We have the cash flow statement of changes in equity, and the notes to the account. So financial analysis entails when you analyze and interpret these data that you can find on the financial statement on one hand. On the other hand, it also entails analysis of every other data. Listen, analysis of every other data that can be found, or that does not belong to financial statement, that does not belong to any financial statement. This is what I mean by that. You know, we know those information, those data we can find on financial statement, right? Income, expenses, asset, liability, equity, and all that. But what about cost of capital? You know, what about amount to be invested in a particular plant and machine, amount to be invested to acquire another business, right? This form of data, or production data, or inventory data, and all these other data, you will see that you might not get them on the financial statement. That is what we mean by it's also fall on financial analysis. So, but today we are looking at financial statement analysis. That is the scope of financial analysis. It entails a wide range of analysis of financial information and data. So we want to look at, but today we want to focus more on financial statement analysis. So financial statement analysis in the case study exam, let me tell you for free that this is this is one of the surest requirements that will come in your exam. Today, now, right now, you should know that no matter what happens, you will do financial statement analysis in your own case study exam. That means the exam you will have this November died. you will do financial statement analysis. It's a constant. Why? The reason is because there's no way you can conduct any analysis of any financial analysis of a company without looking at the financial statement of the company. Again, why? Now, financial statement of any company is more like the whole thing about that company. The whole it gives the information about the every form of activities conducted by that business. In fact, there's this theory that before now, financial information were to be presented in stories, more like a book, right? The way we raise journal entries on transactions. We say that being amounts used to purchase for purchasing an asset, for instance, a motor vehicle, for instance, right? And you debit an account and credit the other account, right? This is the new form of recording business transaction. There's this theory that before now there was nothing like debit and credit. What we used to have is the stories side of the business transaction. Okay, like today, January 1st, 2024. Oh, ABC Limited purchased a motor vehicle for office use at an amount of at the cost of 2 million naira, right? So this is how every of the transaction will be documented. And at the end of the year, a storybook, more like a textbook or a book, will be printed and given to the shareholders or to the owners of the business. So the theory is more like saying that over the years, accountants now look at it that how can we, but that will amount to a lot of stories. I mean, who will have that time to read that? So accountant found a way to summarize the story in form of data, okay, in form of data, so that very quickly the owners can see how much was made in that year, how much was spent as expenses in that year, and the net profit for the year. And they can quickly, at a glance, see how much they invested, how much liability they have added to the capital of the business, then what have they used the capital for, which is the asset. So they can see it. Now, the idea is that this is a summary and does not give so much information, right? And users who are not who don't have financial literacy, who are not financially literate, right, might or will not understand this summarized data. And as such, there is no need again for accountants or financial experts interpret this summarized financial data to the users. To the users. And that is the whole essence of financial statement analysis in case study exam. So ICANN want to test your ability. They want to ensure that you are getting ready to become a qualified chartered accountant, right? That everybody will be looking up to when it comes to financial information about a company. You must be able to pick any financial statement and interpret it, thereby making sense out of the summarized information. on the financial statement. And that is what we are doing in terms of financial statement analysis in case study exam. You are going to be taught how to pick any financial information, break it down, look at it and interpret what the figures means to the users in the exam. So financial statement analysis is when someone look at and explain the information in a company's financial statement, including their management account, budget, and forecast. So this analysis covers what? The financial performance, that is the financial performance, the income statement, including statement of changes in equity, the financial position, the statement of financial position, and the cash flow statement. So this analysis also covers all these statements, including notes to the account, because the notes will give you more information. It's more like additional information on the summarized data that you see on the statement. So financial analysis is also an art of finding out the strong and weak part, that is the strengths and weaknesses of a business. We look for the strengths and weaknesses of a business. So when we are looking at a business, and possibly we are looking at the trends. We are looking at the trends on the performance of the business, the trend on the income statement of those items on the income statement. And over time, over maybe a 5-year period, we notice that there is there is there is a trend of decline on the revenue of the company. That is a weakness. That is a sign of weakness in the business, right? Maybe we also notice, maybe in another analysis, we notice, or we notice a decline in the expenses of the organization. And that is a strength. It means they have been able to tame their expenses, to control their expenses, to manage their expenses. That is a strength. Okay, so we are looking at a financial analysis also is an art of looking at those strengths and weaknesses in the financial information, and it's a way we figure out how well a business is doing. Financial analysis is when we look at how well a business is doing. How well is it doing? Is it making profit or is it making losses? How well is it doing? Is the company financially stable? Is it financially stable, or the business is being run on debt, and there's liquidity risk and financial risk on the business. Okay, so these are the sort of things that we'll be doing in financial statement analysis. However, please note that whatever the analysis we are doing, any analysis that we are doing, we largely, to a very large extent, we largely do what? Depend on the person who commissioned that analysis. It depends on that person who commissioned the analysis. Whatever analysis we are doing will depend on the person who commissioned that analysis. That takes us to different users and their interest in financial statement analysis. And what I mean is that, you see, if we have a user, because because a requirement, a financial statement requirement, listen, a financial statement requirement might just give you the user or that group or that person who has requested for the analysis, and nothing else. They will just give you that information and nothing else, and nothing else. So how will you know the sort of analysis that you will need to conduct? How will you know it, right? How will you know it? So it means that the only way you can know it is by doing what? Is by understanding the interests of that person or that group. It's only when you know the interest of that group of person. So that will take us to the the set of users, the set of users of financial uh, statements and their interest, and the sort of the sort of ratios that we will need to to we will need to compute in order to help the user make sense out of the financial statement. So let's look at these users of accounting information. The first set are the investors. So let's think about it. Let's think about it. As an investor, you are an investor. You have identified about two, three complaints, and being an investor, you have just been paid your gratuity, right? Which amounts to maybe about 5 or 10 million, and you are looking for a company to invest in. So let's think about it. Let's think about it. You have identified five companies. So as a potential investor or as an investor, what are those things? What are the information that you will need on the company? What are those information? One, you will need to know about the profitability of the company. You want to know whether the company is making profit or not, because if the company is profitable, that means the profit will also make returns on investment to the owners in form of dividends. Okay, then you also want to know whether there is always return on investment in the company, and whether the company is financially stable. Whether the company is financially stable. So you are so the reason why you need this information is to evaluate the company's ability to generate what? The ability of the company to generate returns on investment, because that's your interest. If I invest, will this company be able to generate return on my investment? And you also want to know the assess the financial growth potential of the business. So what are the form of ratios that can help you to identify profitability and return on investment? What are the form of ratios? Okay, what are those form of ratios? Return on equity. Return on equity will help us to know how profitable the business is. Then return on asset too is another form of ratio that can help us to identify returns on the investment of the company, including earning per share and some other ratios like return on capital employed and all that. Okay, so what I'm saying is that you can see, if you know who the investor, who the user is, if you know who the user is, you can predict, you can predict the sort of information the user needs, and which can also help you to identify the sort of ratios that can help you to provide more information or analysis on the need of that user. So let's look at another user, creditors, banks and lenders. Okay, banks and lenders. So these are the set of people who lend money to the organization to do business. So the question becomes, what sort of information will they need? What sort of information will they need? What is their interest? Their interest is the money we have lent to this company. Will they be able to pay it back when it's due for payment? Simple. That is their interest. They might also be interested in profitability of the business, because their ability to repay the money, the loan, depends largely on what? On whether they are profitable or not. If they are profitable, there is chance that they will have that cash flow to repay. If they are not, there is high probability that they will not have that liquid asset to repay back the loan as at when due. So we are looking at the liquidity of the business. We are looking at the solvency. Liquidity is their short-term asset. Solvency is their long-term asset. Then their repayment capacity. Their repayment capacity. We can also look at whether they are profitable, their profitability. We can also consider their profitability. So what are those ratios? For the liquidity, we are looking at the current ratio, the quick ratio, the debt to equity ratio. Because if the debt to equity ratio is high, if the ratio of debt to the total equity of the company is high, it means that the company is at risk of is at liquidity risk. They have that liquidity risk. They might find it difficult to pay back. Okay, they might, because of that, they might now that might lead to financial risk. The risk that we have seen that their debt is already high, so we don't want to compound their debt issue. So there's no need to give them debt. They should go and settle the debt they have already. Okay. Okay, so again, you can see that knowing who the user is, right, can help you to identify the sort of ratios that you can compute to provide more information on their needs. Then the management. What about the management? You want to know about the operational efficiency of the company, the profitability of the company, and financial position. Then you can look at the profitability ratios mostly, and the short-term working capital ratio. Okay, that will give us the how efficient the company is. Then what about suppliers? What about suppliers? You know, these are the people that give materials on credit to organization. They have interests that relate that are similar to the creditors. Okay, they share almost the same interest. Okay, then the employees, the shareholders, the shareholders, the shareholders. These are the current owners. The current owner, what do they need? They want to know if they want to know if the company will be able to pay them dividends, okay, and whether the capital appreciation of the business and profitability of the business. So we might be looking at the dividend payout ratio, return on equity, and the price to earnings ratio. So again, and the reason why I have to go through this is a question might just tell you the only information you get in a requirement might just be on the user. So group of people have requested you to do an analysis of the following complaints. That's what they will tell you. So it is now in your own wisdom that you can think it out. Oh, these are the groups. So what will they need to know? Just think about it. Then if you can identify what they need to know, then you can then think about the form of ratios that will help you to provide more information on their needs. So what are the objectives of financial statement analysis? What do we want to achieve on financial statement? So we want to evaluate the strengths and weaknesses of the business, like I've said the other time. Then we want to measure the profitability of the business. Is the business profitable? Is the business profitable? Then we want to also look at the pattern and trends on the performance of the business over years. Right? This pattern can then help us to predict what will happen in the future. If revenue has been growing at a particular rate over the years, then we can predict that in the next 2, 3, 4, 5 years, this revenue can grow at so percentage. Okay, then which can help us to also predict what the future earning capacity of the business, because we have seen the trend in the previous years. It can also help us to compare the performance of of an entity with that of other entities. Okay, so in a particular industry now, you have a client in that industry, so you can compare the performance of your clients in that industry with other players in that same industry. Then we can determine the liquidity and solvency of a business, the liquidity and solvency of the business, then the growth potential of the business. So these are the things that we want to achieve when we do financial statement analysis. So I want to tell you that you remember the Detroit Farms case that we read the other time, right? So we will use it as example for everything we'll be doing under financial statement analysis. We use it as example for everything we'll be doing under financial statement analysis. So you have to pay attention, right? So I've given you the information. We have 2019, 2017 to 2019. We have the income statement, statement of financial position, and the notes. We have the notes. Okay, so we'll be using it to do some computations. Now let's look at the types of financial analysis that we have. The type of financial analysis that we have. We have the external analysis. This is sort of analysis conducted by external person or analyst to the organization. If I'm not part of the organization and I'm conducting analysis on that organization, that is called external analysis. However, if I work in that organization, possibly as a financial analyst or financial accountant or financial manager, and I'm doing analysis of the organization, to provide information to top management for them to make certain decision, then that is internal analysis. Then we also have short-term analysis, where we look at the working capital of the organization. You know, that analysis is to consider the working capital, that is the assets, the current assets and current liabilities of the business, right? That is short-term analysis. We also have horizontal analysis. Horizontal analysis. And this is when we consider the uh the result of an organization over a period of time. So say over 5 years, we are looking at the performance of the business over 5 years. We could use, so we also call it dynamic what analysis. We call it dynamic analysis. So for the horizontal analysis, it could be in form of trend analysis. So let's see. So I don't know who can achieve this. So for the horizontal analysis, a very good example of horizontal analysis is trend analysis. Is trend analysis. Okay? Is trend analysis. And you can see this is an example of horizontal analysis, right? Whereby we look at the performance of the business over how many years? 3 years. Okay, 2017, 2018, and 2019. So trend analysis is a form of horizontal analysis, right? And if you look at this, you will see that we have compared we have this helps us to show the trend over these years. Now for trend analysis, this is how we do it. So when you are doing it in the exam, okay, you might not need to repeat the actual figures again, right? Right. So you might not need to show this. Let me see. Right. Right. This might just be what you will have. Okay. Okay. So this is the trend from between 2017, 2018, 2018, 2019. This is 2018 to 2019. 2018 to 2019. This one is between 2017 to 2018. Okay. So okay, let me remove that. So how do we do trend? That's the next question, right? How do we do trend? How do we do trend? The formula for trend. Formula for trends or trend analysis, equals, we use new we use new minus old all over old. Okay. And what are those things that we need to show? We want to see your absolute change, the naira change over that 2 years between 2017 and 2018. We want to see the naira change as well as what? That percentage what change. The naira change between 2017 and 2018. So the new, what is the new? What is the new? The new is what? 2018. That is 90,560 minus what? Minus 77 what? 623. Okay, divided by what? 77. Okay, 623. That will give us 12,937. Right? That will give us that figure. Then this figure this figure divided by 77,623 will give us 17%. So it means that revenue 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 of DFFP, right, increased by what? By 17%. It increased by 17% from year 2017 to what? To year 2018, which amount to what? To 12.9 million naira. 12.9 million naira. Okay, which amount to that? That is what that means, right? Then we also do for between 2018 and 2019. So between 2018 and 2019, that means what is the new? The new is what? 2019, 107,810 minus what? What is the old? 2018, 90,560. Okay, which is equals to what? Which is equals to 17,250 divided by what? Divided by old. So we divide that 17,000 by old. What is the old? What is the old? The old is what? 2018. That is 90 what? That is 90. That is 95 divided by 90 what? 9560, which should give us about 19 what? 19%. Okay, that should give us 19%. Right? And that is how to do the trend analysis. So you would have succeeded computing for revenue, cost of sales, gross profit, selling and admin expense, operating expense, and all that. So eventually, this is what you have. Just like I did the other time, you should have something like this. You should have something like this. So it means that after the revenue grew by 17% from 2017 to 2018, the rate of growth increased to 19% from 2018 to 2019, which amount to 17.2 million naira. Okay? Okay. So how can you report? Because the whole thing we are trying to do, the whole thing we are trying to do is to make sense out of whatever thing we are doing, right? Is to make sense out of whatever thing we are doing on the financial statement. So how can you make sense out of it? Right? How can you make sense out of it? So let's see. We can say that DFFP DFFP's revenue increased by what? By 17% from 2017 to what? To 2018, which amount to which amount to which amount to which amount to 12,937 million, a million naira, a million. Okay, or or we can write it like this. We can add the three zeros. That is 12,937,000 naira. Full stop. We can continue that it further it further increased by what? By 19%. My network went off a few minutes ago. So let me just recap. It further increased by what? By 19% from 2018 to 2019 to the tune of what? To the tune of 17 million 250 what? 250,000 naira. That is for revenue. That is for revenue. In addition, in addition, in addition, DFFP, DFFP's, DFFP's cost of sales have experienced growth in relation to revenue. In particular, in particular, the cost of sales, the cost of sales of the company increased 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 by what? Increased by what? 17%. Increased by 17%. Increased by 17%. Increased by 17% from when? 2017 to what? To 2018, to the tune of what? To the tune of 10 million, 10 million and 18 what? 18,000 naira. Okay. Okay. It further increased. It further increased by what? By 19% from 2018 to 2019, which amount to what? Which amount to 13,295,000 naira in absolute term. In absolute term. So in the class, if we were to, okay, so in the chat, hello, in the chat, I want to see your comments in the chat. Yes, okay, we can do it. I want to see your comments in the chat on gross profit, selling and admin expenses, as well as net profit. I want to see your comment like this. So I want to see your comments right now. Let's go. Right now, we'll give you just about 5 minutes for that. I want to see your comment. Hello, can I get that? I mean, the same exercise we did in the classroom. So this is basically how to make sense out of the trend that you compute. This is how to make sense out of it, right? This is how to make sense out of it. So I want to see you do for gross. Did I say gross profit? Yes. I can pick operating profit. Someone else can pick profit after tax, but I want to see on three items. All right. I'm waiting. Oh, hello. Can you hear me?
Yes, we can.
Oh, all right. All right. I'm waiting. I'm reading from the chat.
Mr. Jimo, sorry, I missed the question. I had problems with my to hear you.
Oh, okay.
If you don't mind, if you could repeat it, please.
Okay, all right. So I've made statements on revenue, on
Okay,
DFFP's revenue, right?
okay.
I've made statements on DFFP's cost of
Cost
sales,
of sale. Okay.
right? So I'm saying that I want the class to make to make statements on gross profit,
Oh,
operating
okay.
profit, and
Okay.
profit after tax. Some other person might just pick separate line items, but I want to see three, right? So at the end of the day, we should have about five line items. I've done revenue and cost of sales, so I want to see three. So see the way I've done it. See the way I've done it. It's just more like copy and paste self, because
Mhm.
it's almost the same as something. It's just that these numbers will change and the item you are reporting on will change. So I'm reading from the chat. I'm reading from the chat. I'm looking at the chat right now. So this is a process we are to we are to ensure that we monitor properly so that you can learn report writing from here. Okay. Okay. I've seen for Deborah, DFFP's operating profit increased by 17%. Is that correct? Operating profit, yes. From 2017, which amount to um 2919. It further increased by to 2919. Is it in naira? Is it in dollar? Is it in we don't know. Okay, it further increased by 19% from 2018 to 20, which amount to which amount to okay, so please mind the mind the way you put the sentences together, right? So that it can make a complete sense to whoever is reading it. So there's no naira sign, there's we don't know whether this is dollar or all right, okay? So please correct that. Uh Robbie, operating profits operating profit year on year from 2017 to 2018 by by yes, okay, operating profit, let me see that.
17%, not 16%, not
Okay, okay,
17%.
okay, operating profits, yes. Okay, 16%, you can see you put 17%. Okay, from 20 to 20, this indicates indicative of companies improved revenues while having better control over costs, which increase at lower rate than revenue. Okay. GFFE profit after tax increased by 9% from 2020, which amount to this. It further increased by this. Okay, okay. I can take that. Robin, okay, you made correction
I'm
on
trying to
that.
correct my.
Okay, good. DFFPs, yes, I got that. Zainab, DFP gross profit increased by 17% from 20 to 20,000 to this. Good. Additionally, the gross profit in 2010, profit in 2020 increased to increase by this, which represent this. Okay. Uh Jide, gross profits Daily gross profit increased by 17% in 2018 and further experienced growth of 19% in 2019. Uh, so this is not the way you are supposed to write it. I mean, for GD, when you are putting the percentage change, you also have to give us the absolute change, and that's the essence why you have computed the percentage and the absolute change. I mean, this is the basic requirement by ICANN if you are writing on trends in the exam. Who is that? Please, we are listening to your conversation, oh, Deborah. Tell Oga that we can hear him. He's disturbing.
No, sir, we can't hear you, sir.
Sorry, sorry, I'm muted. So I was saying that vertical analysis is more like the opposite of horizontal analysis. Why the horizontal analysis look at multiple years? Vertical analysis will help us to look at to analyze a single year. It will help us to analyze a single year by converting each line item. So for statement of profit or loss, for instance, it will help us to convert each of these line item as a percentage of revenue. Now, so for statement of profit or loss, each line item divided by revenue times 100. Okay. However, for statement of financial position, for statement of financial position, each line item divided by what? Divided by total assets times 100 times 100. So let's see the vertical analysis for let's see the vertical analysis for uh, uh, um, let's see the vertical analysis for for this company. Let's see the vertical analysis. Okay. Okay. So all the time you always see for revenue to be 100%, right? Revenue will always be 100%. Okay. And you can see that we have convert the cost of sales as percentage of what? Revenue. And we have 77%. It means that for every 100 naira sale made, right, 77 naira will be must have been spent on what? On direct cost or cost of sales. That is what it means. For every 100 naira made, only 23 naira is left as what? As gross profit to cater for other operating expenses. After what? After deducting what? Cost of sales. You can see how we are making sense out of it. For every 100 naira made, 17 naira is always spent on what? On selling and administrative what? Expenses. For every 100 naira made, 6 naira is left, right? After what? After taking care of what? Direct cost and what? And selling and what? Administrative expenses. Again, and for every 100 naira made, you can see only 4 naira is left as what? As profit after tax. So what I'm saying is, you will see vertical analysis will help us to look at a single year. Of course, we can then compare it over a period of time, which also becomes a form of what? Horizontal what? Analysis. So we can do vertical analysis in form of horizontal analysis and look at it in horizontal analysis too, right? So we have seen for 2017, this is for 2018, and this is for 2019. Let me see if I can make sense out of that. Right, okay. So that's how to do vertical analysis. I've given you the formula here. Okay, I've given you the formula here. So let me show you again. So for revenue now, this is how to compose for revenue. For revenue, it will be revenue will be I don't have that figure. Revenue will be revenue as a let me scroll up. Revenue divided by eh? Revenue divided by revenue times what? This one will give us 100% for cost of sales. For cost of sales, that will be equals to what is my cost of sales? What is my cost of sales in 2017?
Top.
What is my cost of sales? For cost of sales. So you say cost of sales divided by what? Cost of sales divided by revenue. Divided by revenue. Divided by revenue. Multiplied by what? 100. That is how we arrive at what? 77 what percent. Okay, so you can continue like that. So each of those line items over revenue for the income statement and for the statement of financial position, each line items over what? Over total assets. Right. So these are the types of financial analysis that we could conduct on any business, right? So let's look at various techniques for financial financial statement analysis. Various techniques for financial statement analysis. So please let me sound a warning before we start now. Now, these various techniques, when you are for the purpose of this exam, For the purpose of this exam, please, I want to warn you that if you are not being told on what to do, more like you are given the open hand, you are given the open ended question. So I will advise you to just focus on just two major two: trend analysis and ratio analysis. Just focus on those two, right? And leave out the others. But if you are working in practice, maybe you are working on a client, file or financial statement, then you can employ multiple techniques. Why you use trend, ratios, you can also use common size and you know any other one, right? Okay, right. So what are those techniques for financial statement analysis? So the first one is comparative financial statement analysis. So what we have done here is a form of comparative financial statement analysis because we are comparing the performance over multiple years, right? Over a period of time, you can say over 3 years. So this is a form of comparative financial statement analysis when we are comparing over a period of time, right? So that is it. So we can compare based on ratios, based on trends, based on whatever, right? So that is comparative analysis. Now, common size analysis. When we talk about common size analysis, vertical analysis that we have done here, the vertical analysis that we have done here is a form of is in fact is common size analysis. Another name for vertical analysis is common size analysis. So let me see if you can see the yes. Okay. So 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 let's see a common size statement. Okay, common size profit or loss statement for for DFFP for DFFP. Okay, so this is the common size statement. You can see it's still the same thing. You see the same thing for what we did for that vertical analysis. This is common size statement, and what you will see is what we were able to do the other time. Okay, now how can we make sense? How can we make sense out of this common size statement? Just like what I was saying. So you can see the interpretation is that for every 100 naira revenue made, 77 naira goes to what? Goes to goes to cost of sales. So let's see let's see a typical statement on 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 that interpretation of DFFP's what common size profit or loss what statement. So let's see. So we might not want to make comments on the revenue, right? Right? But let's start from the cost of sales. So we can say the cost of sales, the cost of sales of DFFP, the cost of sales DFFP of DFFP remains 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 steady remains steady at what? At 77% of revenue over the 3 years under review. Over the 3 years under review. This consistency, this consistency, yes, suggests that the company, the company, the company has been able to manage what? To manage its direct costs, right, effectively, because it's not fluctuating. It's not going up, coming down, going up, coming down, right? It, without any significant what? Fluctuation. That's our observation. Any significant fluctuation, right? But 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 it also it also indicates that no improvements no improvement has been made to reduce the direct what? Cost in relation to what? To revenue. It also mean that for every 100 naira of revenue made, 77 naira is expended on direct what? Direct costs, which leave little what? Revenue to cover for other what? Administrative expenses. Okay, okay. I've 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 made I've made my I've made sense out of that what? Out of that, right? Over the 3 years. So I can also do that for gross profit. I can do that for gross profit. I can do that for gross profit. Gross profit is stable at 23% of revenue over the 3 years. While consistency in gross profit indicates a steady performance in terms of revenue versus direct cost, the percentage may be on the lower side, which could limit what? Limit profitability Okay, a gross profit margin of 20% suggests that for every 100 naira of sales, the company retains what? Just 23 naira after accounting for cost of goods sold. Okay, so let me give you, few minutes to write on maybe three items, maybe three, just as we did for trend analysis. Can we do that?